Welcome back to Radio Blue Mountains. You are listening to The Business Show, and it's our pleasure to bring back to the show Rob Lees from Mortgage Choice. Rob, was it last fortnight you were absentee and we had
where was I?
Andy here?
Yes, that's right.
Yeah.
And I can't remember what I was doing.
You were at some training course, I think.
Oh, that's right. Yeah, that's right.
That's what
2
happens
weeks
when you
already.
become a grandfather.
That's right.
Yeah. I don't think he's just become a grandfather.
No,
I think
not
you were
just.
sprouting
Not
about your
just, yeah.
11 lovely
Yes,
grandchildren
yeah,
off air
and,
before.
just come here via the bike shop and, well, actually, better not say anything because it's a birthday present for one of them. So I better just zip
yeah,
the lip
One
right
of the
now.
11 will now be
Got
interested.
no idea what we're buying there.
Love it. Well, welcome back to the show. You've got, you want to talk to us about this tumultuous, I was saying before to Karen, we're talking about the property market and what's driving it. And I think a lot of what is driving our property market values and the downturn is potentially some tumultuous times in the finance sector. So
yeah, so
talk to us
it seems.
about
I
that.
thought we'd talk about that. There was actually a couple of articles in the weekend papers. One was Looming Loans Crisis, our version of the GFC, which sounds very, very dramatic and a little bit scary. Another one here, Mortgage Pinch is coming up. So it just seems that a lot of the concern, and there are genuine concerns about as borrowers come off their interest-only loans, particularly investors, and it used to be all investors had interest-only loans. You'd have to say 99%. And as they come off their interest-only loans to principal and interest repayments, it's going to make those repayments a lot more expensive. And the research suggests that a lot of borrowers are going to have trouble making their payments. So it does create some big concerns. It used to be too that you could opt to extend your interest-only period, whereas the banks now are doing an assessment on that. So even if people wanted to extend, they may not be in a position to extend. The bank won't allow them because they may no longer qualify. So, there are some genuine concerns about that.
It might be interesting too to see what happens when out through the next, say, 5 years as these interest-only loans roll to P&I. If the investors don't do anything, they'll roll to a 25-year P&I term, which is actually going to be significant repayment. I wonder whether or not we'll be able to refinance them into 30-year terms to at least potentially reduce that payment and maybe make it more affordable.
I think the problem is, as you would find too, Peter, that there's a lot of people who are actually not like they might be wanting a top-up on their loans.
Yeah.
They're actually not qualifying for the loans they actually did qualify for 6 months, 12 months ago.
Yeah.
So I'm not sure. I think there are going to be people who are going to find themselves in a difficult situation. Some of the gloom and doom, and I wouldn't go this far, like this article here that's talking about our version of the GFC is comparing that to the prime crisis in America.
Yeah.
However, that was made a lot worse because of the fact that they were giving loans to people that didn't have stable employment, were actually on Centrelink, well, it wasn't Centrelink, welfare benefits
Or
and all
not
that sort of
even
thing.
on any form of benefit.
was,
Yeah, though I do think, with a lot of the particularly investment loans, unless they put rents up, a lot of people are going to struggle.
I think there is the reality that
Because
it is going to be
wages
difficult.
have not gone up.
Well, this is exactly right. There hasn't been wages growth. Rents haven't gone up. So there are going to be people struggling, and that also is going to put a lot more downward pressure on our property prices. So it's a flag that we've just got to be aware of.
Yeah, because there are a lot of people who have given, I think, family guarantees as well that quite haven't understood the implications.
Yeah, I've got one going at the moment that we're offloading the parents as a guarantee because they're downsizing and the kids are okay, but it does mean that they're now going to have to pay that mortgage insurance that they didn't pay initially. And fortunately, they've renovated the home and they're able to do it. But like you say, they're potentially it all depends on a number of those circumstances, doesn't it? To what options are available.
It does, and I think people probably need to start. My advice would be to start preparing for that now, particularly if you're on interest-only loans. I think, a number of things. I think firstly, you need to start budgeting for that. So even to calculate what your principal and interest payments are going to be, and actually start making that now, or putting money aside so that you know that you're going to be able to afford it. That's going to put you ahead on your mortgage, and give you a little bit of a buffer. So I think for most people, it's always better to pay a little more, or even have it sitting in the offset account. And probably if you're an investor, putting that money in the offset account, because it just gives a safety buffer for when that comes about. The other thing is to look at repricing the loan. And, you know, I'm finding I actually did a variation for a client this morning who has just switched their interest-only investment loans to principal and interest, because the interest rate's about roughly 1% lower.
Yeah.
So the rates are much lower on principal and interest loans, and I'm finding a lot of investors now are choosing principal and interest repayments because they're going to save so much more on their interest rate.
Yeah.
So that's very important. And I suppose my main thing would be to get some advice from your mortgage broker. We don't just do loan transactions.
Yeah.
We provide advice. So we can help with a lot of that sort of thing. It may be also looking at things like locking in fixed rates, all those sorts of things we can give some advice on,
Well, Catherine
so
was,
that people aren't caught out.
predicting before, or said that she'd seen
Yeah,
or read somewhere about 3 rate rises that they
In the US
in the US.
Yeah, well,
this year.
Yeah, well, that's right. Although, you know, we're different to the US. I think the way that's impacting us is, I think in terms of funding costs. So I think we had a question on that later too, in terms of the rate rises, the out of cycle rate rises that have taken place. And I think that's probably how it will impact us, because the cost of funding is more. I read an article by Shane Oliver, chief economist from AMP, on the weekend. He still talks about having one more cash rate cut from the Reserve Bank of Australia.
Yeah.
Because our numbers are so low.
I think that's very optimistic.
Yeah, he's conservative, but he's certainly putting it
Yeah.
off. But I think it's probably going to be more the outer cycle rate rises that are going to happen.
But I think that just reiterates your point that you just said earlier about, you know, seeing your mortgage broker and getting that advice, because it could be that, you know, cut your interest-only loan off now and secure yourself a nice fixed rate, as an example, as a P&I loan, but have those conversations and come up with a strategy.
And start budgeting for rate increases.
I think so. Yeah, absolutely. And in some cases, it may be that it's unaffordable, and it might be better in some cases to offload it.
Yep.
To avoid, you know, bank foreclosures and things like that. Because the other impact on this is in terms of housing values.
Yeah.
And we're certainly experiencing a soft period, and all the indicators seem to suggest that we're not going to see massive rises for probably about a decade.
Yeah.
So we're going to be going sideways for some time now.
Yeah.
So I think we've got to be careful about that.
And
I
but
think
again,
the
I
other-
think that's all about global economy as well.
Yeah,
Yeah.
and
You
I
know?
think it's really careful to have those conversations and be clear about what your goals are, because the last thing you want to do is have a knee-jerk reaction given doom and gloom that you read in the papers and stuff like that.
Yep.
So again, you know, have a conversation with your finance person and come up with a strategy.
Yep.
And I think
Like
as
you
a
say-
business owner as well, because we sort of got a bit of a theme about mental health, and I think finances is a real reason, you know, for people's
That's one of the biggest
it's
reasons.
you know. And I think having conversations and not being embarrassed, like if you have got yourself into a mess with credit cards or pay, you know, interest only, and now it's you know, instead of, you know, just burying your head in the sand, start to have conversations, because not dealing with it isn't going to make it any better.
No.
Well, the longer you leave it, the worse it gets.
Correct.
Yeah.
There's a lot less that we can do once things have got out of control, and when credit records are impaired and all that kind of thing.
Yep.
So it's better to be on the front foot with all of that.
So Rob, talk to us about, you've got here a number of smaller lenders have made out-of-cycle increases to their variable rates in the past week. Why do you think that's happening?
Yeah, and I think it's probably to do with our comments earlier. It's the cost of funding, and people, most borrowers
Do you
look at
wanna
that and
explain
say,
to our
why?
listeners what cost of
I'll-
funding
I'll,
means?
I'll explain that.
Yeah.
Yeah. Most people look at it and think, what's going on here? And I'm really angry with the banks for it, because the cash rate has not changed. But what people need to understand is the way banks fund loans is not just through, certainly not through the cash rate. It's people deposit money and they use that for lending. They've got to retain a certain amount of funding on their balance sheet before they can lend it. And what happens is there's not enough, particularly with the smaller banks, there's not enough funds available through deposits. So they normally source those funds from overseas. And as Catherine was saying, because of these rate rises that America, the Fed has raised rates, and I think they were at 0% though.
Yeah, they were.
They've had 3 rate rises. There's probably going to be more. It means that the cost of overseas funding is costing more. It's wholesale funding. Yeah. They buy it from overseas, so to speak, and then make it available for lending. And because those costs are going up, or the lenders have decided it's eating into their profit margin, they reckon they've absorbed some of it. I don't know, but so they say. And now it's time to...
Why wouldn't we trust a bank?
That's exactly right. So they say, is what I said. And now they've decided to pass it on to consumers. And I think most of those rate rises have been around about a 0.1%. But I think it's possible we'll see some more of those.
Yeah, it's always a good time too, isn't it, to check what your home loan rate is on those, because those... where, you and I go back long enough to know that there was a time that rates didn't move outside of any RBA announcement, but that's definitely these out-of-cycle rate rises are something that's a new thing. So, you'd encourage anyone that's got a loan that hasn't had it reviewed in the last 18 months to 2 years to absolutely, and like you say, it could be, I think you mentioned earlier that you're looking after some customers at the moment where you're just repricing current debt, which is, it's better off in your pocket than the bank.
They save, it's around about 1%, I think they save. I mean, I say to my clients, let's talk every year and review the rate, because the banks are constantly playing around with products. They'll sometimes have a product that gets you in with really good pricing, and then they'll actually make that product obsolete. It'll become an old product, no longer available, increase the price on it, and then bring another one.
Yeah.
And so it makes a lot of sense, and we're doing a lot of maintenance with our clients at the moment, making sure that they're on the best product with the best price, not changing banks a lot of the time, but just making sure that they're getting the best rate. Banks hope that you won't notice.
Yeah.
And that
it's
you'll
funny,
do nothing.
isn't it? Because we're doing exactly the same thing at the moment, just going through our entire customer base.
Yep.
And I think that's something that if you've used a mortgage broker in the past and they're not looking after you like that, then you really should get a better relationship, because that's mortgage brokers are remunerated by trail, which means that if they do have that they have written a loan for you, they are getting paid ongoing for that, and so therefore they should be.
So we're very happy to do that, and don't hesitate to contact your broker and just ask. And my clients do that all the time.
Yeah.
Am I on the best rate? Can I do better?
Yeah.
And
it's no skin off our nose to do it for customers.
I want to do
is
it.
Yeah.
I absolutely want to do it.
Yeah.
I,
And it's like anything,
absolutely.
like, our lives, I think, are so busy
Yeah.
that things like that, it was like private health insurance. Like, so, I mean, same thing, like we hadn't reviewed ours in years.
Yeah.
And the stuff we were paying for, like, was just irrelevant to our life.
Yeah.
And stuff that we should have now include, like hip replacements and things like that as we get older,
things start to change. That's exactly right.
weren't included.
Yeah. I think any of those things where you're paying insurance companies, like you said, health insurance, but even your house insurance, your car insurance, it's worthwhile reviewing all
Once
of that
a year.
stuff, because, take an annual leave day and spend the time actually going through it, because you'd probably save yourself $1,000 over, finding yourself better deals.
Because health insurance is the same bit like with interest rates with banks. Like they send you a note, and you think, oh yeah, that'll go up in September. It's only July now. Let's wait and see. And then September comes and something else has gotten in between,
But it just seems too hard.
or it's just like, can't do it. Can't do it.
Yeah. And it's funny, isn't it? The health insurance is an example. There's lots of those online models, and I know I could be getting a better deal. I pay like a wounded bull for my health insurance.
Yeah, same with
and
us.
I find it overwhelming that I keep doing nothing. I wish there was a broker that I could go to for
that's
health
right.
insurance.
That's right.
Explain it to me.
Yeah. And I don't know if I choose this, if I choose
and
this
what
one.
should I have? What do I need to think about? Do I need to be thinking
But
about?
that's the same with mortgage, and broker. Like I've got clients who just refuse to go and see a mortgage.
I don't understand that.
No, I don't understand.
I've said to them, you're doing the wrong thing because you're going to be up for capital gain. This is the way you're going. I said, go and talk to them. There's other ways you can structure this.
That's right.
Now,
I think the thing is, it's just, I like the way I see it is, it's not about us doing the transaction, getting the best rate. The thing that we bring to it is advice.
Yeah, 100%.
Advice in terms of structure. It's also, it's running numbers for people, what they can do, what they can't do. It's a whole range of different products that are available. And then when we do present the application, as I say, I think it's like a lawyer presenting a case to the court.
Yeah.
Where we're presenting their case to the bank in the most favourable light.
Yeah. Pretty cool job, hey Rob.
Well, I think it is.
Yeah, I like it.
I love going to battle for clients,
Yeah.
and I love getting a win.
Yeah, it's quite rewarding
It
to think
is.
that you can
Very
have
satisfying.
such an impact on
Yeah, absolutely.
someone's, like it's
Absolutely.
it's just finance, but it can have
Yeah.
I actually sorry,
the wrong loans can get mental health issues. I remember
Well, yeah,
when
sure.
they
They
went
went
up
for-
to 18%. I can't remember what, and they locked in a whole heap of people into, they were nearly up to 21% by the time they refinanced them into RAMs. This would have been 20, 25 years ago.
You're showing your age.
I know. Well, it was actually my in-laws were
Yeah.
caught up in it.
Yep.
And we were paying mortgage of 21.
It's
Yeah,
crazy.
isn't
Oh,
it?
dear.
So,
Yeah.
Rob, for all our listeners out there that are thinking, oh, maybe I should have a look at my rate and make sure it's competitive, or am I paying for bells and whistles that I don't need, or
Yep.
how am I going to plan for my future? Where do they find you?
Well, give us a call at the Blaxland office, 4739 9749.